One of the biggest frustrations I've seen among traders on the Nigerian Stock Exchange isn't finding stocks to buy. In fact, buying is usually the easy part. The real challenge comes later. It's when you want to sell. I've seen traders buy a stock at 5 naira. The stock moves to 8 naira, then 10 naira, and then even 15 naira. Their portfolio shows a beautiful profit. They are excited. They think they've made money. Then they place a sell order and nothing happens. No buyers. 1 day passes, 2 days pass, 3 days pass, still no execution. And that's when they realize a painful truth. A profit on paper is not the same thing as money in your account. The problem isn't that they picked the wrong stock. The problem is that they ignored liquidity. And here's the scary part. Many traders don't discover this mistake until it's too late. One of the most common conversations I've heard among NGX traders is, I bought A or B stocks, but I've been unable to sell them. If you've ever found yourself in this situation, then this video is for you. Today, I'm going to show you the exact trading view screener settings I use to find stocks that are not only good trading opportunities, but are also easier to buy and sell on the NGX. We'll cover what liquidity means, why liquidity matters, the best trading view screener filters, how to verify liquidity on a chart, common mistakes traders make, and a powerful liquidity rule that can instantly improve your stock selection process. Because finding a winning stock is important, but being able to exit when you want to is even more important. If you're new here, don't forget to hit the subscribe button and turn on notifications so you get notified anytime I drop a new video like this. Help this video get at least 100 likes so it can get to more people and they can benefit from this as well. Remember guys, this video is for educational purposes only. I am not a financial advisor and this is not financial advice. Always do your own research before making any investment decisions. So let's get started. So first, let's understand why illiquid stocks can be dangerous. Many traders believe, if I buy low enough, I'll make money. And that sounds logical, right? Unfortunately, the market doesn't work that way. Imagine buying a stock at 5 naira. A few weeks or months later, it rises to 8 naira, then 10 naira, then maybe even 15 naira. At this point, you're feeling like a genius, right? Your portfolio is green, your account shows profits, everything looks great. But then you decide to sell, and suddenly nothing. No buyers, no execution, no exit. Your profit exists only on paper. This happens because of low liquidity. Liquidity simply means how easily a stock can be bought or sold. The more buyers and sellers participating in a stock, the more liquid it becomes. The fewer buyers and sellers are available, the harder it becomes to enter or exit that position. This is why professional traders don't just ask, can this stock go up? They also ask, can I get out quickly if I am wrong? Or can I get out when I want to take profit? And that second question is often the difference between a successful trade and a frustrating experience. And here's a quick question for you. Which stock would you rather own? Stock A trades 50,000 shares per day. Stock B trades 20 million shares per day. Pause the video and drop your answer in the comments. Most people will immediately choose stock B, and from a liquidity standpoint, that's usually the right answer. But here's where many traders make a mistake. They assume volume alone tells the whole story. It doesn't, because a stock can show huge volume today and still fail other important liquidity tests. That's why later in this video, I'll show you additional filters that help separate genuinely liquid stocks from stocks that simply had a temporary spike in activity. Now let's talk about how liquidity appears on the NGX. Highly liquid stocks usually have high trading volume, consistent daily activity, active participation from buyers and sellers, narrow bid-ask spreads, and institutional participation. These are often found among large-cap companies, banking stocks, telecom stocks, and major industrial companies. On the other hand, illiquid stocks usually show very low volume, long periods of inactivity, large gaps between buyers and sellers, and difficulty executing orders. Here's the danger. You can buy these stocks easily when excitement enters the market. Maybe there's a news release, maybe social media is talking about it, or maybe everyone suddenly becomes interested. But when that excitement disappears, liquidity disappears too. And in a falling market, liquidity can dry up faster than most traders expect. That's why liquidity should never be an afterthought. It should be part of your stock selection process from the beginning. Now, here's something interesting. Some stocks can look fantastic on the chart, have strong momentum, good fundamentals, positive news, yet they can still become dangerous trades. Why? Because price movement alone doesn't tell you whether you'll be able to exit your position. That's why professional traders check liquidity before they check profit potential. So let me show you exactly how. Now let's get practical. To find liquid stocks, we're going to use the TradingView stock screener. Open TradingView, go to Products, select Screener, and then select Stocks. By default, you'll see stocks from US markets. Click on the Market Selection drop-down and select Nigeria. You'll now see NGX listed stocks. At the top of the screener, you'll find your filters. These filters help narrow down hundreds of stocks into a manageable watch list. So let's start with the most important filter. Filter number 1, volume. Volume shows how many shares are traded during a session. This is the heartbeat of a stock. A trader should check volume before risking money, because no matter how beautiful a chart looks, if nobody is trading it, getting in and out can become a problem. So select volume from market data options, set it to above 200,000 to 500,000, or maybe 100,000 to 500,000 shares. You don't want it too low, and you don't necessarily need it extremely high either. Adjust based on your preference. You'll see the total number of stocks listed on the screener reducing as you apply your filters. Filter number 2, average volume. Average volume helps measure consistency. Instead of looking only at today's activity, it looks at trading activity over a longer period. So select average volume, use 30 days, and set it to above 200,000 to 500,000 as well. This helps remove stocks that had one lucky volume spike but are usually inactive. Filter number 3, relative volume. Relative volume compares today's volume with normal volume. So select relative volume and set it above 1. This means the stock is trading more actively than usual. Higher relative volume often signals institutional participation, news-driven momentum, breakouts, or increased market attention. Now, here's a hidden liquidity trap many traders fall into. A stock may suddenly show huge volume for one day. Maybe there was positive news. Maybe there was speculation. Maybe a large investor entered. You, as a beginner, see that spike and assume the stock is liquid. But after that one day, the activity disappears. That's why I never rely on today's volume alone. I combine volume, average volume, and relative volume together. This helps identify stocks that are active today and consistently active over time. At this point, you'll notice that these filters have reduced the list of stocks to a much more manageable number. Sometimes that will include large cap stocks, other times it may highlight lesser known stocks that are attracting unusual volume and market interests right now. That's one of the reasons stock screeners can be so powerful. They help you discover opportunities that many traders may not be paying attention to yet. In fact, some of the best performing stocks often show up on a screener long before they become popular with the average investor. Now, for beginners, These three filters alone can dramatically improve your stock selection process. They help remove dead stocks, inactive stocks, and many low liquidity traps, okay? By the way, if you're watching this and you're serious about improving your results in the stock market, whether it's the Nigerian stock market or the US stock market, I do offer one-on-one coaching and mentorship for traders and investors, including kids who want more personalized guidance. Inside the coaching program, I work closely with members to understand how to analyze stocks, identify quality opportunities, manage risk properly, and build a structured investment approach instead of relying on guesswork or emotions. You will also have the opportunity to join our trading and investing community, where we regularly discuss market opportunities, share educational insights, review charts, and help members become more confident in their decision making. The goal isn't just to help you find opportunities today, it's to help you develop the skills and discipline needed to navigate the market for years to come. If that sounds like something you'd be interested, you will find more information through the link in the description below. Now, before we move on, remember this. If all you use are volume, average volume, and relative volume, you are already ahead of many traders in the market. These are the ones I consider essential. These three filters alone can dramatically improve the quality of stocks you analyze. They will already eliminate many weak and inactive stocks. But if you want to take your screening process a step further, there are a couple of additional filters that can help you identify even stronger candidates. So let's look at them. Optional filter number 4, market capitalization. Market capitalization measures company size. Larger companies generally attract more institutional investors, and that often creates better liquidity. So select market cap filter and focus mainly on mid cap and large cap stocks. So you can set your preferred range. Optional filter number 5, bid-ask spread. This is an advanced liquidity filter. The spread measures the difference between the buying price and selling price. Smaller spreads generally indicate better liquidity. Lower spread usually means smoother entries and exits. And here's my personal rule. If I cannot comfortably sell my position within a reasonable time frame, I usually avoid the trade because profitability matters, but liquidity is what allows you to actually realize those profits. Alright guys, answer these in the comments. Which is more dangerous? A stock falling 5% or a stock rising 20% but having no buyers when you want to sell? Drop your answer below. And here's another challenge. Would you rather own a stock that gains 40% but takes weeks to sell, or a stock that gains 15% and can be sold immediately? Think carefully, because professional traders understand that liquidity is part of profitability. Now, the screener is only step 1. You must always verify on the chart. Look at the volume bars below the chart. Ask yourself, are there consistent volume spikes? Is volume active every week? Are transactions occurring regularly? Or are there long periods of inactivity? Rising volume often confirms growing interest from market participants. It tells you there are active buyers and sellers, and it gives confidence that trades can be executed efficiently. But liquidity alone isn't enough. We still want technically strong stocks, right? So look for stocks trading above major support levels, above key moving averages, or showing signs of accumulation and strength. Let's quickly cover some mistakes. Mistake number 1, buying simply because a stock is cheap. Cheap does not mean liquid. Mistake number 2, ignoring volume completely. Volume is one of the most important indicators in trading, yet many traders barely look at it. Mistake number 3, following social media hype. A stock may trend online today, but if liquidity disappears tomorrow, you could become trapped. Mistake number 4, taking oversized positions. Even liquid stocks can become difficult to exit if your position size is too large relative to normal trading activity. So try to avoid these mistakes. So before buying your next NGX stock, ask yourself these 5 questions. Is volume active? Is relative volume above normal? Is the stock consistently traded? Is the spread reasonable? Can I realistically sell the stock if market conditions change? If the answer is yes to most of these questions, you may have found a quality trading candidate. And here is a powerful strategy many traders overlook. Once you've filtered for liquidity, don't immediately rush to buy. Instead, look for liquid stocks that are moving sideways in a tight range. Why? Because institutions often accumulate shares quietly before a major move. When volume starts increasing while price remains relatively stable, it can signal that larger market participants are building positions. This doesn't guarantee a breakout, but it can help you identify potential opportunities before the crowd notices them. If you'd like me to create a full video showing how to find stocks accumulating sideways on the NGX, type sideways in the comments. So remember this, the best stock isn't necessarily the cheapest stock, the best stock isn't necessarily the fastest rising stock, and it's definitely not always the stock everyone is talking about. The best stock is often the one that gives you both opportunity and flexibility. An opportunity to profit and the flexibility to exit when you need to. That's why liquidity should always be part of your stock selection process. If you found value in this video, hit the like button, subscribe to the channel, and turn on notifications so you don't miss future NGX trading and investing strategies. And if you're serious about improving your trading skills, check out my beginner trading practice workbook using the link in the description below. The workbook is designed to help traders build practical chart reading skills, understand technical analysis, improve risk management, and develop a structured trading process. The links are also available in the description. Thank you for watching, and I'll see you in the next video.